As Washington prepares to join hands with Beijing to cool down the tariff war, the financial world is holding its breath. Is this a step in US-China tensions or just a temporary break before the storm? The United States and China are preparing for a key round of trade negotiations this weekend, with the potential to reduce tariffs from 145% to 50%, a move aimed at reviving stalled bilateral trade. This tariff cut, if implemented, would represent the most significant de-escalation since the trade war began and could unlock critical flows of goods that have been frozen under current restrictions. According to Bloomberg, July 5, 2025, and WSJ, both governments face mounting internal pressure. The US is grappling with persistent inflation and voter fatigue over high prices, while China's manufacturing sector struggles under weak global demand and domestic deflationary risks. A rollback to 50% may not restore pre-2018 trade dynamics, but it could offer short-term relief for exporters, manufacturers, and markets heavily exposed to US-China flows. Strategically, the talks also reflect shifting geopolitical calculus. Both sides appear more willing to stabilize relations amid broader global economic uncertainty, particularly with elections looming in the US and slowing GDP forecasts in China. While markets focus on tariffs and trade, a dramatic first is reshaping the Vatican, and the political symbolism may run deeper than expected. Former President Donald Trump has praised the election of Pope Leo XIV, the first American ever chosen to lead the Catholic Church, as a great honor, calling it a historic turning point for global religion and Western political symbolism. The unprecedented appointment marks a dramatic shift in the Vatican's power dynamics, long dominated by European influence. Pope Leo XIV's American background signals a new era of transatlantic religious leadership, potentially reshaping the Church's geopolitical posture. Religious analysts from CNN and Financial Times note that this election may also carry wider implications for the Church's stance on globalization, technological ethics, and political neutrality. While the Vatican remains officially apolitical, the cultural weight of a US-born pope could influence perceptions in regions grappling with Western interventionism. For Trump, the announcement serves a dual function, reinforcing his alignment with Christian conservative voters ahead of the 2026 midterms and projecting soft power symbolism at a time when US global influence is under pressure. But while spiritual diplomacy takes center stage, economic diplomacy between the US and UK remains stuck in preliminary gear. This deal, described by US trade representative officials as a pathway, not a destination, falls short of a comprehensive free trade agreement. It lacks binding commitments on key regulatory standards and sidesteps contentious sectors that have long strained bilateral relations. Digital services taxes remain a particular flashpoint. The UK's levy on US tech giants such as Google and Amazon continues to draw opposition from Washington, which argues it disproportionately targets American firms. Meanwhile, long-standing metal tariffs imposed under Section 232 have not been rolled back, dampening optimism in manufacturing circles on both sides of the Atlantic. According to Reuters, August 5, 2025, and Financial Times, business leaders view the framework as cosmetic, warning that without resolution of these issues, investor confidence and cross-border capital flows will remain tentative. Strategically, the Biden administration is treading carefully, balancing pressure from domestic industry with the desire to maintain transatlantic cohesion amid rising global protectionism and election-driven economic nationalism. Despite the limited progress in policy, markets appear to be pricing in optimism, at least for now. Equity markets across Asia and Europe posted modest gains today, buoyed by rising optimism over the upcoming US-China trade talks and the potential tariff rollback from 145% to 50%. Investors interpreted the renewed diplomatic tone as a possible turning point in global trade tensions. In Tokyo, the Nikkei 225 rose 0.6%, while Frankfurt's DAX edged up 0.4%. London's FTSE 100 also closed higher by 0.5%, driven by gains in export-oriented industrials and raw materials sectors. Market analysts at CNBC and Bloomberg attribute the rally to improving expectations that Washington and Beijing may de-escalate their long-running tariff standoff, easing pressure on global supply chains and reducing inflationary spillovers. However, the gains were measured, reflecting cautious sentiment. Investors remain wary of potential last-minute breakdowns in negotiations or face-saving political gestures that fail to deliver structural change. The positive momentum also suggests that markets are now highly sensitive to diplomatic signals, underscoring the outsized influence of geopolitics on financial pricing in 2025. While markets react to macro signals, corporate fundamentals are also coming into focus, starting with a major earnings beat in Europe. Germany's Commerzbank reported a first-quarter net profit of €834 million, sharply exceeding analyst expectations. The strong performance was driven by higher net interest income and significantly lower than expected loan loss provisions, signaling improved credit quality and tighter balance sheet discipline. According to Reuters, analysts had forecast earnings in the €700 million range, reflecting cautious sentiment amid macroeconomic uncertainty. However, Commerzbank outperformed thanks to rising interest rates in the Eurozone, which boosted lending margins. Loan loss provisions came in well below consensus, indicating that German corporates and retail borrowers are showing stronger than expected resilience in a still volatile economic environment. Commerzbank's result also reflects a broader trend in European banking, where rate hikes have improved interest income but raised concerns about credit risk. The bank's ability to control delinquencies while expanding margins may position it favorably as consolidation pressures mount across the sector. But as banks post robust earnings, Washington is eyeing a new revenue stream, targeting the ultra-wealthy with a potential tax hike. The increase would effectively restore the top rate to pre-2017 levels before the Trump-era tax cuts reduced it to 37%. According to WSJ and CNBC, the measure targets individuals earning over $400,000 per year and is part of the Biden administration's fiscal realignment agenda. Supporters argue the change would rebalance tax burdens after years of disproportionate gains by high-net-worth individuals during the post-COVID market boom. Critics, however, warn that higher rates could discourage investment, lead to tax flight, or distort capital allocation. Analysts say this move is as much political as it is fiscal, with national debt nearing $35 trillion and mandatory spending rising. The White House is under mounting pressure to present credible revenue measures ahead of the 2026 budget cycle. If passed, the hike would also align the US more closely with European peers on top-bracket taxation, potentially influencing debates around global minimum tax frameworks. And while Washington focuses on taxing the rich, Asia's trade pacts are facing their own set of challenges, this time with Japan and South Korea. This statement marks a shift from earlier optimism that the two agreements could be fast-tracked. Initial hopes have been tempered by deep differences in key areas, including digital services, auto regulations, and steel sector access, issues that have stalled similar talks in the past. Analysts at Reuters and Bloomberg report that both Tokyo and Seoul are resisting US demands for stricter labor and environmental rules, while Washington is pushing back on Asian digital tax frameworks and industrial subsidies. The result is a complex, technical negotiation process with no near-term resolution in sight. This development illustrates the Biden administration's pivot from sweeping multilateral trade deals to bilateral negotiations centered on strategic leverage, especially in the Indo-Pacific, where supply chain control and semiconductor policy remain top priorities. Market watchers say the prolonged timeline could delay planned investment realignments, particularly for US firms seeking diversified sourcing in Asia. Meanwhile, while new deals stall, existing trade flows between the US and China are grinding to a halt, except in a few strategic sectors. Bilateral trade between the US and China has slowed to near zero levels, with only a narrow exception in personal electronics, according to officials familiar with the current flow data. The sharp contraction reflects ongoing geopolitical tensions and unresolved tariff barriers. Based on the transcript, most sectors, agriculture, pharmaceuticals, industrial goods, have come to a halt. Only personal electronics such as smartphones and laptops continue to circulate between the two markets. Bloomberg analysts attribute this exception to irreplaceable production interdependence in tech supply chains. Final assembly in China and component sourcing from the US remain tightly integrated, making full decoupling in this sector economically impractical in the short term. However, this selective continuity is not a sign of improvement. Instead, it signals a shift toward fragmented trade, where politically tolerated sectors persist and all others collapse. The Wall Street Journal notes this emerging two-track trade model increases operational uncertainty for multinationals. Market reaction has been cautious. Volatility is rising across logistics and tech-linked equities. Corporations exposed to cross-Pacific trade are re-evaluating inventory strategies, supplier networks, and political risk assessments. Meanwhile, the US faces another unresolved trade front, this time with the UK, and the issue is digital taxation. The United States and the United Kingdom remain deadlocked over digital services taxation, a core issue stalling progress toward a full-scale trade agreement. According to the transcript, the dispute has become a key friction point in ongoing talks. Washington views the UK's digital services tax as discriminatory toward American tech firms. London argues it reflects fair taxation of revenues generated within its jurisdiction. This impasse underscores a deeper transatlantic divide on how to tax digital activity in the absence of a unified global framework. The failure to resolve this issue is directly impacting broader trade negotiations. US negotiators have made it clear. Without changes to the digital tax regime, a comprehensive trade deal remains off the table. Business leaders warn the delay is increasing regulatory risk for cross-border tech and digital service providers, with potential consequences for future investment flows. Meanwhile, in the heart of Europe, tariff effects are hitting small and mid-sized firms, especially in Germany's industrial core. German small and medium-sized enterprises, SMEs, are facing growing pressure from international tariffs, with the steel and pharmaceutical sectors under the most scrutiny. As stated in the transcript, policymakers and analysts are closely monitoring the impact of trade barriers on export-reliant businesses across Germany's industrial backbone. According to Financial Times and Reuters, rising input costs, disrupted raw material flows, and regulatory uncertainty are eroding margins for mid-sized manufacturers. Steel producers are reporting delayed shipments and cost overruns, while pharma exporters are dealing with new compliance hurdles in non-EU markets. SMEs form over 99% of German companies and account for two-thirds of employment. Their vulnerability to tariff shifts presents systemic economic risk, especially as global trade becomes more fragmented and politicized. Analysts warn that unless trade tensions ease or compensatory policies are introduced, investment and hiring plans in these sectors could be scaled back, undermining Germany's post-pandemic industrial recovery. At the same time, currency volatility is adding another layer of complexity, starting with renewed strength in the US dollar. The US dollar strengthened significantly in the latest trading session, exerting downward pressure on key global currencies, including the Japanese yen and Swiss franc. According to the transcript, the greenback's sharp appreciation is raising concern across FX markets. Currency analysts cite a combination of stronger-than-expected US economic data and delayed rate cut expectations from the Federal Reserve as key drivers. Bloomberg and WSJ report that the yen briefly slipped past 157 per dollar, its weakest level in over 3 decades, prompting speculation about potential intervention by the Bank of Japan. Meanwhile, the franc's depreciation reflects capital flight from lower-yielding safe haven assets amid rising US Treasury yields. For global investors and import-dependent economies, a strong dollar tightens financial conditions, raises the cost of servicing dollar-denominated debt, and increases imported inflation, particularly in Asia and emerging markets. Volatility in FX markets is expected to remain elevated as traders recalibrate expectations around US interest rate policy and geopolitical risk premiums. But it's not just currencies feeling the heat. Bond markets are flashing warning signs as investors reassess the Fed's next move. US Treasury markets saw a sharp decline in the benchmark 10-year yield as investors pushed back expectations for Federal Reserve rate cuts. According to the transcript, the sudden move reflects growing consensus that the Fed may hold rates higher for longer amid sticky inflation and resilient labor data. Bloomberg reports that yields fell over 12 basis points to 3.94%, the largest one-day drop in over a month, driven by repositioning from bond funds and institutional asset managers. WSJ highlights that recent Fed commentary has dialed down expectations for a cut before Q4. The drop in yields signals both a repricing of monetary policy forecasts and rising investor concern over long-term economic growth. Lower yields typically reflect increased demand for safe assets, especially when equity markets are volatile or global risks are elevated. Strategically, the shift is being closely tracked by corporate treasurers, mortgage lenders, and sovereign debt issuers, all of whom are sensitive to cost of capital dynamics tied to Treasury benchmarks. And as fixed income adjusts to delayed easing, equity markets are looking to political signals, with Trump offering his own take on the opportunity ahead. Former President Donald Trump has publicly urged investors to buy stocks now, citing optimism that US-China trade negotiations may lead to significant tariff reductions. According to the transcript, Trump linked potential equity upside to a smooth outcome in the talks and deep tariff cuts, from 145% down to 50%, which he claims could unlock massive gains for US markets. Analysts note that this statement carries political as well as market implications. While no formal agreement has been reached, Trump's commentary is aimed at reinforcing investor sentiment and positioning himself as a driver of market confidence, especially ahead of key election cycles. Bloomberg reports that equities exposed to China, particularly in tech, industrials, and semiconductors, saw modest intraday gains following the remarks, as investors priced in a potential easing of trade headwinds. However, experts also caution against overreacting to political signaling. The market remains vulnerable to sudden breakdowns in talks, as well as unresolved structural issues in the US-China economic relationship. But while political voices fuel market speculation, central banks are staying quiet, leaving investors guessing on the next rate move. The Bank of England, BOE, kept its benchmark interest rate unchanged, but provided no forward guidance on the pace or timing of future rate cuts, leaving financial markets uncertain. As noted in the transcript, this ambiguity has complicated market pricing. Investors had hoped for more clarity amid moderating inflation and mixed economic indicators. According to Financial Times and Bloomberg, Governor Andrew Bailey declined to commit to a timeline, citing ongoing labor market tightness and global volatility as key variables. Traders trimmed bets on a summer cut, and short-term gilt yields rose modestly in response. This data-dependent silence contrasts with more explicit communication from the Fed and ECB and reflects the BOE's caution amid fragile consumer confidence and weak productivity data. The absence of a policy signal creates uncertainty across sectors, from mortgages to corporate borrowing, and may weigh on UK equities in the near term. Meanwhile, outside of central banks and trade talks, global philanthropy is also under scrutiny, this time from Bill Gates. According to the transcript, Gates called the move a moral step backward and argued it undermines America's role as a global leader in humanitarian support. This criticism comes after Musk publicly supported congressional efforts to reduce foreign assistance budgets, including direct funding to USAID programs. Financial Times confirms that multiple USAID initiatives in sub-Saharan Africa and Southeast Asia have been suspended or defunded as a result. Gates warned that reducing America's global aid footprint, particularly under the influence of individual billionaires, weakens diplomatic credibility and diminishes long-term strategic influence, especially in regions where China and Russia are expanding their presence. He emphasized that leadership is not measured by military power or technology alone, but by the ability to sustain moral responsibility in times of global crisis. From trade talks and tax reforms to currency shifts and geopolitical influence, the global economic order is being redrawn in real time. Investors, governments, and institutions are no longer reacting to isolated headlines, but to a systemic transformation that's redefining risk, power, and opportunity.